Hello, this is Japanese Economic Review Channel. Today we analyze the Q1 2026 Corporate Sentiment Survey. We observe a stark divide. Large enterprises show resilient optimism, plus 4.4 BSI, while small firms plunge into pessimism. Behind this lies a universal crisis: 59 consecutive quarters of labor shortages. Consequently, capital strategies are bifurcating, defining the future of Japan's economy. Looking at the macroeconomic snapshot, the economy is clearly stratified. Large enterprises report positive sentiment and domestic views. However, small enterprises face severe declines. Yet, one reality unites them all: a severe labor shortage, highlighting that economic optimism is currently a luxury afforded only to well-capitalized firms. This divergence is driven by specific sectors. Large manufacturing firms, particularly in production and electrical machinery, are driving a three-quarter streak of rising sentiment. Conversely, sectors like steel and utilities are dragging down the lower-tier economy. Small businesses bear the brunt of these sector-specific headwinds. Why this gap? Large enterprises, plus 8.0 points, are insulated by broader recovery and capitalization. In contrast, small firms, operating closer to ground-level realities, are acutely vulnerable to localized demand shocks, resulting in a bleak minus 11.6-point outlook. The closer to the ground, the harsher the view. The defining gravitational force in Japan's corporate landscape is labor scarcity. Across all tiers, companies report insufficient headcounts. For large enterprises, this marks an unprecedented 59 consecutive quarters of structural labor shortages since 2011, dictating strict operational limits across the board. Despite these constraints, FY 2025 financial health shows resilience. Overall revenue is expected to grow by 2.3% and ordinary profits by 2.4%. We see massive profitability surges in info communication electronics, plus 29.8%, offsetting steep collapses in steel, minus 41.5%, and utilities. Looking to FY 2026, we see a strategic pivot. While revenues are projected to grow by 2.2%, ordinary profits may contract slightly, minus 1.0%. However, capital expenditure remains highly robust at plus 3.5%. Corporations are accepting margin compression to aggressively fund top-line growth and structural investments. This CapEx drive responds directly to equipment insufficiency. Total CapEx for FY 2025 is expected to rise by 3.9%. Manufacturing leads this charge at plus 7.6%, heavily driven by chemicals, plus 16.5%, and automotive, plus 13.3%, signaling a massive shift towards automation and capacity building. Execution strategies reveal a resilience gap. When asked why capital plans deviate, 37.7% of large firms cited, quote, proceeding as planned, showcasing long-term stability. Conversely, 51.2% of small firms cited, quote, changes in economic outlook, proving they are forced into reactive, weather-dependent pivots. Profit allocation perfectly illustrates this divide. Large enterprises channel 61.0% of profit into CapEx for growth. Meanwhile, battered by labor shortages, over 60% of small firms must allocate their capital to employee returns just to survive and retain talent, a true talent tax. To summarize sector diagnostics, macro tailwinds strongly favor production machinery, automotive, and chemicals, driving positive sentiment and heavy CapEx. The headwinds, however, are severely contracting margins in steel, utilities, and petroleum products, polarizing the economic landscape. In conclusion, Japan's bifurcated economy presents three realities. 1. A size premium where large firms monopolize optimism. 2. An automation imperative to detach growth from the 59-quarter labor shortage. 3. A talent tax trapping smaller firms in a reactive cycle to maintain operations. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.